Hi, everybody. Welcome to episode 3 of Larry the Money Guy. I want to thank you guys so much for joining us today. A little bit different structure today. Actually, the other day I had the opportunity to talk with Rob Sousa, who's out in Southern California, about some of the impacts of the big, beautiful bill and some tax planning opportunities, strategies, changes, tax-free Social Security benefits, what actually made it into the bill and what didn't. So today I wanted to welcome you guys in, and then we will move to the recording of that. As always, if you have any questions, please feel free to drop a comment in the chat, and look forward to talking to you all soon. Thank you so much and enjoy.
Welcome to Advisor Insights, where we challenge financial advisors with real questions from everyday Americans. Get ready for real-time insights on the issues that matter most. My name's Rob Sousa, and today we're tackling the confusion surrounding the big, beautiful bill. Whether you like the name or not, we have to live with the consequences. And today we're tackling the issues that have the biggest effect on retirement income. And with so many changes and revisions, it's tough to know what actually made it into the final version. And more importantly, how will it affect your retirement benefits? If you're a federal employee, you may be wondering what this bill means for your pension, your savings, your overall financial security. To help break it all down, we're being joined by a certified financial planner who's seen the impact of these types of policy changes that have happened to affect retirement planning for not only his clients, but his audience. He's been helping federal employees and pre-retirees think strategically about how taxes and legislation will impact retirement income. Let's bring in Larry Gatz from Copperwood Financial to join us. Thanks for joining us today, Larry.
Hey, thanks for having me.
So let's break this down. First, let's talk about the goal, right? What was behind the no tax on Social Security idea, and why did it matter?
Right. So at the beginning, right, and I think Trump campaigned on this, and I think actually both candidates, Harris and Trump, campaigned on, we want no tax on tips, we want no tax on Social Security, and those are things that when it was a goal of the bill, and then it didn't happen. So it didn't quite deliver everything that we hoped for when it came to eliminating taxes on our Social Security benefits. But I would say that there was a silver lining. So the big thing that came out is that now there is a bonus deduction for people over the age 65.
So I heard it from both sides. There are still advisors, even after the bill has been approved, there are still advisors who are saying it still eliminates tax on Social Security, with the caveat of, for a majority, some saying 80% of retirees. So how can both be true?
Yeah, I think what happened, right? The way that Social Security gets taxed today, or maybe I shouldn't say today because the law was effective for 2025 and moving on. So the way that Social Security is currently taxed, right? There's they calculate your provisional income, and they take a look. If you're a married filing joint couple, if 100% of your taxable income plus 50% of your Social Security benefits is over certain thresholds, then your Social Security becomes taxable to you. They didn't get rid of that, but what they did is when they added on this new deduction, the goal is that now we have more seniors, more retirees who are claiming Social Security benefits because of these increased deduction amounts. When they go to file for their Social Security, they're not going to owe taxes because their taxable income is going to fall below the thresholds. So kind of like you said, there's there's different thresholds. And I think the number was before this bill, about 60% of Social Security filers, 65% were getting Social Security benefits tax-free, right? Their income wasn't high enough to the point where it was going to make their Social Security taxable.
So just give me an example. If you talk about threshold, so let's just say married filing jointly, what's that threshold where if they don't show more than that amount of ordinary income, and then what's that amount for a married couple filing jointly?
So for married filing joint, the thresholds are $32,000 and $44,000. And so if we want to use use round numbers, let's say that somebody has let's say a $40,000 pension and they're getting $40,000 of Social Security income. When they go to file their taxes, they're going to look, the way that they run the provisional income calculation is they take 100% of that pension, so $40,000, plus 50% of your Social Security benefits. So that puts you at $60,000. $60,000 is over the $44,000 threshold by $16,000. Put me on the spot to try to do math. So we're $16,000 over that threshold. We've got 32 to 44, so we have another $12,000 there. So I won't bore you with the details. 6,000 plus 85% of the 16,000 over that is how much of the Social Security benefits get taxed or are taxable at your income tax rates. And then the next step of that is that then they take that taxable Social Security number and they apply your standard deduction, your itemized deduction, and then they reduce taxable income and they figure out how much money that you owe the government at the end of the year. So
if I understood one thing of everything you just said, I heard the word deduction, and I heard that they're adding a deduction to bring down your calculable income because they're bringing it down with that credit, which then to me makes sense comparing it to like child tax credit, like that brings down your income too. I know two separate things, but the idea is the final legislation is allowing you to bring down your taxable income amount before applying taxation, right?
Correct. Two calculations. The first one is how much of your Social Security is going to be taxable to you.
Got it.
The formula for how we calculate that did not change. What did change is once they determine how much of your Social Security is going to be taxable to you, plus your other taxable income, IRA distributions, pensions, Social Security, taxable Social Security. Now they take that number, they apply your standard deduction or your itemized deduction. They subtract it off of there and they say, cool, your taxable income is what's left.
Okay. So from the planning perspective, for those people where these deductions do have the potential to make an impact to reduce or eliminate the Social Security tax, what do they need to be thinking ahead of time when they're considering where do I take my income from and how is that going to affect my taxable income at the end of the year so that I can try and stay under these so-called thresholds to minimize my taxation? Like,
correct.
What things do I need to take into consideration?
That's the $1 million question of like, where do we go from here and how does this affect planning? What we're seeing, especially with federal employees, because federal employees, if you're out there, right, you get to retire as early as 57 or maybe even earlier, right? But you can retire early. And so what you want to look at is, okay, there's kind of a storm of things that happen. And I would start by saying, like, Dave Ramsey and Susie Orman and all those people out there told you while you're working to defer taxes, right? And the thought was that when you get to retirement, you're going to drop to a lower tax bracket. So in theory, while you're working, you're in a higher tax bracket. So you want to defer your income then, and then you're going to take it later in life when you're retired. Well, now we kind of have this storm brewing. So now when you turn 65, the standard deduction amount, and we'll talk married filing jointly, it's $6,000 per person or $12,000 total on top of the current standard deduction. So this year, the base standard deduction is $31,500. If you're over 65 years old, there's a additional deduction of $3,200. That's always been there. And then there's a senior bonus deduction of $12,000. So when you add all of those things together, that can, that deduction is as high as like $46,700. So
that's why they're saying more people, that it will help more people than not.
Right. If your taxable income is below $46,700, you're not going to owe any income taxes in this situation.
But wait a second. Let's face it. I live in Southern California. You live in Chicago. How are people supposed to live off of $40,000 a year in retirement?
Right. And that's kind of the joke that we use a lot of times, right? Like Social Security tax came around originally when Reagan was president. And he said, hey, this $32,000 level, $25,000 single, $32,000 for single filers I said that wrong. $25,000 single, $32,000 the first threshold for married filing joint. This is only going to impact the wealthiest retirees in the country, right? And then under the Clinton administration, the new $44,000 threshold came out and said, yeah, that little tax worked so well the first time around. Let's add a little bit to it. And somehow, right, those thresholds have never once moved. So now we're sitting here, like you said, we're at $46,000 of income being tax-free. Like if you're in a high cost of living area, like you and I are sitting here on opposite sides of the country, that's not that helpful.
Okay, so let's talk about that. So you talked about the benefits and how, yes, this could reduce taxes for majority, but what about the people who are not in the majority? And I'm going to ask you to kind of finish answering my last question, which is for those of us who need income more than $47,000 or make significantly more than $47,000 in our retirement to maintain our lifestyle, what then? What do we do?
What do you do, right? So kick back to that everybody told you to defer taxes in your TSP, your 401k, your IRA accounts in a tax deferred manner. So most retirees, right, their primary sources of income are a pension, if they've still got one. Federal employees, you do. Social Security income, which gets taxed based on that formula. And then IRA retirement savings distributions. We can't really control the pension amount, right? You get what you get. We can't really control, unless Congress changes how Social Security gets taxed, we can't really control that. But what we can control is that IRA distribution. So now we want to look and potentially pull forward things like Roth conversions. So if you're retiring at 57 or 60 or 62, now we want to start looking at like, hey, what if we start moving money over to the Roth tax-free growth side of things, pay our income taxes now with the thought that now when we get to age 65, now you still qualify for that bonus deduction. Now less of your Social Security is potentially taxable to you. And now you're not subject to Medicare income, Medicare adjustment amounts. So there's a storm of like all three of these things kind of hit. The more taxable income you got, the harder it's going to hit you.
So, but what I just heard you say is that based on the increase in deductions, I could still live the same lifestyle, but with less taxable income. But because I'm getting more credits and maybe I'm drawing an income from a tax-free source like a Roth, then I could get to my lifestyle amount that I need without having the equal amount of taxable income as I did when I was working.
Correct. So
but it sounds like then you got to get started before retirement.
Yes. And that's the big, this probably puts more of a pressure. For years we've been talking about, hey, like we need to take a look at how much your IRA 401k, what are those distributions going to look like and how are they going to be taxed? before the big beautiful bill passed, number one, the tax rates were all set to expire and tax rates across the board were going to go up. Okay, we got an extension on the tax rates. And so it's now tax rates aren't going up, but
just to clarify, and I don't mean to push back, but thank you. They were about to sunset. Is in the new bill, is there also a sunset for keeping the taxes where they are right now?
The sunset, the income tax brackets, the change was made permanent. So
it is made permanent. Okay.
Enacted in. The bonus senior deduction, I believe, has a 2028 phase out. It's effective for the next several years, but there's it's likely that some of that will get extended.
Right, but like the tax rates that got extended, that also could be. We don't know. But I always find that with our government, it's easy for them to give a benefit, but taking it away is usually really unpopular. And that's why we have some of these archaic tax laws and benefits, structured benefits, because no congressman wants to vote for changes that's going to hurt their voter base. You take it away and you're going to have lots of people really upset with you.
Right. Which senator in the world who's up for re-election wants to jump on the grenade of like, oh, hey, Social Security's in trouble. Like, I vote that we just cut everybody's Social Security benefits by 30% to square up the system. Like, nobody's jumping on that grenade, right?
Exactly. So I unless you have anything to add about those that really you've given them some really concrete tools, that better to look at it before you retire than after. Your deductions are going to increase once you retire. And if you look at it that way and you pull for some tax-free sources, you can live at the same lifestyle. And what do you think you could cut your taxable, if you've done this really well? Maybe you have 5 years more, you've done this well. Can you cut your taxable income in half and still live at the same amount?
I think so. I mean, you got to look, right? If you've got $1 million in a retirement account, if over 5, 6, 7 years, you're able to start moving that money over to Roth, right? Now, if you need, between any pension, Social Security benefits for you and your spouse, if the number that we need to pull out of that retirement account to kind of fill that funding gap is let's say $30,000 a year, well, that $30,000 a year maybe pops you up into some different income brackets, different things going on. But if all of a sudden that $30,000 comes out of a Roth account, that's tax-free money. Doesn't show up on the return, doesn't cause Social Security to be more taxable, it doesn't cause Medicare premiums to go up, doesn't affect the phase out on this new senior deduction. I don't think that we touched on that. There's a income phase out. It starts, I think for single people, it starts at why am I blanking on the number here? So the senior,
I was debating with you before the show, and I said 180,000, and you said no, that's total phase out. And then you gave me a number that was somewhere like 80,000, 100,000 less. It starts to phase out 75,000 single, 150,000 married filing joint, and then it's a total phase out at 175 single, 250 married filing joint. And that's how they're so-called, I think, appealing to the whole, well, if you make this much money, you can afford to pay tax on your Social Security. So let's finish up today's episode on addressing that audience so that we've addressed each audience. What if I've accumulated so much money that there's no way I'm going to be able to, and I didn't prep in advance. So no matter what, every dollar I pull out is just going to cost more and more taxation. I'm trying to preserve wealth. I'm 65. Is it too late for me now? Is there anything I can do?
I don't think so. Right. But the benefit that you have is that you'll hear any financial planner say this, right? You need to have a plan. You need to have a look at this. The good news is that you get to file your taxes, or bad news, every single year. So you take what you need, build a plan that says, hey, what if we accelerate distributions out of this account, and we know that we're going to be above, any of these thresholds for a couple of years? But then in the future, right, by the time we get to 70, what if at 65, instead of turning on Social Security benefits, what if we delay Social Security to 70? Now we're opening up a window that says, cool, we'll fund our lifestyle with IRA, 401k, TSP distributions, and we'll do Roth conversions. So that way, when we get to 70, we turn on Social Security, which has grown. Now we get more of that to be in the tax-free bucket.
Okay,
right?
last question. If you hold off until age 70, do you still get the deductions, or is it you only get the deductions when you turn on Social Security?
You get the deductions, and here's another, you always get the deduction, whether you're claiming Social Security or not. And that bonus deduction applies even if you itemize your taxes. So we talked about the standard deduction numbers. The other piece of this tax bill, for me sitting in Chicago, and I think I pay about a kidney a year in property taxes. You're probably similar out there in California. That SALT deduction, state and local tax, there was a cap. If you were trying to itemize, you could only deduct $10,000 a year of state and local taxes. Well, now they've bumped that up to $40,000. So between like mortgage interest, property taxes, things like that, plus some charitable giving that you're doing, there's likely going to be a window, especially in a high tax state like Illinois, California, New York. We know who we are, to itemize your taxes now. Well, that senior bonus deduction applies even if you itemize. So that was a cool thing that they stuck in the bill too.
Well, I'll tell you what, this is a lot to consume. And I know you have an upcoming masterclass where you take time and actually work with people, work through the numbers, show the calculations instead of talking about it. For me, it's hard to see numbers in my head. So I'm sure you'll get deep into it. Well, when is that masterclass, and how can they sign up to join it? I think it is online. Is that right?
Yes, shameless plug for what we've got going on. August 14th, we're going to be hosting a masterclass targeted at this one is going to be targeted at federal employees. The changes that didn't happen in their benefits, how this impacts their benefits in particular. An hour long, going to be held over lunch hour webinar. Feel free to, we'll get information out there if you want to join. Would love to have you.
Or I encourage you to check out any of Larry's channels. So you can just at Copperwood Financial, and you can find his socials. I know he puts out a video each week where you break down topics in bite-sized pieces. So if anybody's looking for financial advice, please do not contact me. And you can choose to go to copperwoodfinancial.com, and you'll get much better results. Well, Larry, hey, I appreciate you taking time out of your day and breaking down something that I've talked to 3 advisors in the last week. I don't think even the 3 advisors are all on the same page about how to, because it's so fresh and it's so new. So people are coming up with creative ways to solve these problems and equip people. But you're actively out in the community helping people. So I appreciate you taking the time, stop by and break it down for us as well. And in the future, join Larry next week on his YouTube channel. Until next time, we'll see y'all in the digital world.
Thanks.
All right.